One.
Hello traders, Shawn Lucas here. So great to be with you this afternoon. Looking forward to chatting with you a little bit about placing stops. It seems to be one of the biggest questions we get around here is where do I place those stops? It just seems like every time I put my stop in, I'm either getting stopped out or something doesn't work about it. I just don't know where to put my stop. And so, we're going to address that question today in our Apiary Live presentation. So before we do that, make sure you subscribe to our YouTube channel and let's see what we can, and if you have comments or questions at any time, type those in and we'll make sure that we try and address those either right now live during the presentation or even after the presentation. We can come back into the YouTube, we can go back into YouTube and type in responses to your questions. So even if you're not here live, go ahead and type in questions in our chat box. We'd love to make sure we clear up any questions you have. So what about stops? Let's talk a little bit about stops today and see where do we place them, how do we use them, what are we doing when we place stops. So stops really are designed to help us protect us from risk or risk of loss in the market whenever we're in an investment. We need to identify where we're going to get out if the market goes against us. So that's why we use stops, and stops are designed to help remove a little bit of the emotions that we have when we're in a trade, because we don't like to take losses. It's not, we're not built to take losses, we're built to win. And so sometimes if left to our own choice, when we should be getting out of the market because everything is going against us, we're sitting there lost in a decision where, oh, do I get out? I think it'll come back. No, let's just use a stop, a hard mechanical stop to get us out of the market before we start second guessing ourselves. So, but with that, where do you put the stop, in the first place? Where does it go? Because you don't want to, put it too close and miss out on opportunities. And then of course you don't want to put it too far away and miss out on all this profit or an opportunity for the market to turn around. So there's going to be, there needs to be we need to put some thought into where we put our stops in the market. As a general rule, I had a couple of orders placed I had a couple of orders placed, and I had we were going to go through the process of picking our stops, but looks like the market just decided to run on us, and so I didn't get a chance to put the stops in. So let's do this. Let's go into a long. We're kind of in the upper end. We're up in the upper edges of a trading or of a range right now. We've got a bunch of resistance levels up here. So normally we wouldn't go into a long position right here, but let's do it anyway. And let's go through and try and decide where to put your stops. So the first thing you'll notice is right down here, I've got a stop loss automatically set at 35 pips away from where we're currently at. The question I always get is, Shawn, that's ridiculous to put your stops 35 pips away. So the way I look at this is that that's a stop, yes, but it's kind of just an eject button. What I want to do is I want to get that stop far enough away from the current price action so that I don't get whipsawed with a stop loss. And then what I can do is I can come in here and I can adjust that stop up or down depending on where I want to place that stop. So even though I put a 35 pip stop in there, that will only be like in case something really dramatic happens, a very long tail event. It's more of a get out of the market. you know, an eject button. If you're a pilot, you're flying along, and all of a sudden, you know, you're crashing, all your engines go out, you eject. So you can look at that 35 pips as an eject button, or you can look at it as something that you're just going to put on the books for now, and then you're going to adjust it, or, you know, whatever it is. So personally, I like to put some kind of an eject button, and then I like to close out of trades manually, but we'll talk about that in another session. Looks like we made a profit on that trade. So let's put another one in. Now let's kind of identify where to place our stops. So the first thing I look for when I'm in front of the market like this is all of my layers of support or resistance. And so you can see right here, I have a couple of layers, I've drawn a couple of layers, a resistance layer above where the current price is, a support layer below where the current price is, and then another layer below that. And we can start setting up even more layers down the price scale, down the price chart. So the best thing to do is, if you're above a layer, then stops ought to go below below your layer. So like right here, did we get closed out? I couldn't see what happened. We're out of that trade again. Let's go ahead and do it again. Not sure what happened there. All right, so we're in a long position right here. So if I want to place a good stop point, I'm gonna let me think how to say this. Any area between the red lines on the chart is going to be free, what I call free price movement. So the market will freely move between these red lines. Once it hits or comes close to a red line, those are resistance levels or support levels. And so what I like to do is I like to place my stops on the opposite edge of one of the red lines. So a stop would be placed somewhere down below that red line, or if we're trading above it, I may put that stop in below where even though we got into the trade below it, I may adjust that stop up underneath the next red line if we're trading above it. So again, think about when you're placing these stops, just make sure that your number one rule is to make sure that you're below one of your support lines. Because anytime that market comes down to that support line, we expect it to find some support there. So as we come down to this line, let's watch and see how this market comes down to that support line. We'll expect to see it kind of stop and pause and maybe trade a little bit around that. And so if I'm going to get out of the trade, I want to make sure that I give that trade enough room to find support and move higher if I'm in a long position, if I need that market to go up. So let's go ahead and place a buy here. And let's widen this so we'll widen that up a little bit. It's going to hit our target again. I'm trying to demonstrate where to put your stops in, but we keep making money. I don't know why that is. I love it though. All right. I need a bigger take profit. Yeah, you're absolutely right. Okay, so we'll widen that take profit a little bit here. So here we are. We've got this support line, and let's watch. See how it's coming down into the support line right here, and it's starting to find a little bit of support. It's slowing down its downward movement and forming a tail. You can see that kind of pop right back up out of there. And so this is the zone where we're finding support come into the market. So if I'm going to place a stop, putting it right at the red line is not a good idea. but somewhere close underneath it, because if we want that point, you want to find that point where support breaks and you've got free price movement down to the next support. So where is that point on the chart? And I don't know if you can see it really good on YouTube or not. I'll zoom in as much as I can here. But you can see we drew the red line right there, and we had just a little bit of price action underneath that on this candle right here, and then we had a little bit of price action underneath it on the current candle there. And so if I placed my stop right on the line, I would have gotten stopped out and then watched the market climb away like it is right now. You see that? If I place that stop slightly below the line, then there's a chance that it wouldn't, you've allowed yourself enough flexibility to catch the market as it moves away from the line, but not so much that you're going to lose everything if it breaks and moves down to the next line below that, if that makes sense. So anyway, that's the first rule. Now, where do those lines? So when you get into the market, you've got to know where those lines are. I think, if you look at the floor traders that are working the pits in New York or in Chicago or something like that, they go into they don't have the luxury of sitting there and analyzing the market like you and I do. Things are moving too fast. They don't have computers down there. They basically go down with earpieces, and people are telling them to do things, and buy this, buy now, sell this, sell now. But regardless of whether they're what they have, they'll go into that pit knowing where their levels are. They know, I'm a buyer at this price, I'm a seller at this price, and then they just take action around those levels. So every time you sit down for a trading session, you need to know, where are those levels? At what level are you going to be a buyer? At what level are you going to be a seller? At what level are you going to build a position? At what level are you going to get out of a position? And so these lines, these horizontal lines, represent those levels. And then placing your stop is just a really simple process of making sure that you give it enough flexibility to find support or resistance at those levels and the market move, and not too much flexibility that you take unnecessary losses in your account. So in this case, right now, again, we're right back down at that exact same level where, is support going to, I'm asking myself, is support going to form here, or do I need to place the stop? Do I need to adjust the stop? And let's just do that real quick. Do we need to adjust the stop up? Do we need to adjust that stop up so that we don't take the loss if it breaks lower at this point? So it should actually, at this point, we should have it break. It should break lower at this point, just gauging by how price is forming here. So we should get stopped out of this. Now you'll notice that I've got three tails, 1, 2, the third tail's right here, and I'm just slightly below that. That stop now should stop us out if it breaks lower. We'll watch that for a second here, see if it breaks lower. But it should stop us out right when we cross down below those wicks. And then what I'm anticipating seeing at that point is a bigger candle down to find support at that next level. That next level was formed over here, and a little bit of price action here. So we can adjust that. Yeah, we should be hitting that stop any minute here. Okay, so we stopped out of that trade right there. 2.6 pips. Now let's watch and see how price is starting to form a little bit of free fall, right? So that stop was placed perfectly to avoid the free fall, the breakout momentum build, all the way down to that next layer, which we're starting to see support. So that was a perfectly placed stop. It did exactly what it needed to do. It gave us enough room, enough flexibility for the market to find support if it's going to find support and build off that level, but not too much room, not too much that we took unnecessary losses in its free movement zone down to the next support level. So that stop was a perfectly placed stop for us. And you can see it now, it's in that free floating zone again. And let's see, we should get some price support. Now, one thing you'll need to, these lines that you put in these support and resistance lines that you put on the charts, that'll take a little bit of practice as you try and figure out where the best place is to put those. But as you watch and observe the market trade around those levels, you'll start to see the supports form. You'll start to see that, those wicks start to form, and you'll be able to use that. You'll see how price starts to form, and you'll be able to use that knowledge in subsequent trades as you place different trades. At any rate, that's kind of the nuts and bolts. A lot of people use different indicators as stopping points. As long as it stays above a moving average, I don't stop. So they're using the moving average as a stopping point. Some people use average true ranges as stopping points. It doesn't really matter. I mean, whatever you're comfortable with. If you're using an indicator like that, then that stopping point is, more of a function of, it's more for you than it is for the precise positioning in the market. But if you want precise positioning in the market, what you're trying to do is you're trying to find those levels where support or resistance is going to form in the market. And then you want to make sure that you adjust that stop, number one, to give it enough flexibility to build that support or resistance. Number two, not too much flexibility that you take unnecessary losses if it doesn't form. So those are the, you're either placing stops for your own mental well-being, or you're placing stops so that you find those right levels in the market. Either way, it's a good thing to use those stops. Either way, whether it's for your own peace of mind, or whether you're trying to find that perfect level in the market. Either way, it's good. Let me take a couple questions here. Do you consider the even number magnets, example 1.16, and are they important levels? So the even number magnets definitely influence price, and they're going to have a natural layer just simply because a lot of orders tend to be stacked up at those even numbers, especially for longer term trades. So what I've shown you here is we're looking at price action on 1 minute charts. But if we're looking at holding trades, currency positions over long periods of time, months and months and months, well, I may place my stops around a 1.15 or a 1.14 or 1.13, just because, it's going to get me in the right ballpark. For example, if we look at the hourly chart here, we're going to see a layer of support, maybe a daily. We may have to look at a daily. We're going to see a layer of support around that 1.15, Give that a second to load. So we take one of these lines here and we put it down at the bottom of these support lines right here on the daily chart. Now let's zoom right in. So that layer is that line that I put in there is 1.1519. But then if I really fine tune that a little bit to pick up those tails there, now I'm at 1.1505. So you can see that there's a lot of support right here at that 1.50 area, and a lot of orders are going to be stacked up at that point. This was in the past, but it would also that same concept holds true moving into the future as well. But great question. Another question here. Another comment, Joseph says, it depends on the situation and the time frame that you're trading. I think I agree with Joseph. Any stop is going to be dependent upon your situation and your time frame. Situation meaning, I think, sometimes I just need a stop. Me personally, doesn't matter if I'm maximizing every pip out of the market. I need a stop, and that's and if I need a stop, if I need to get out of the market because I need it, then by all means you need to get out of the market because you're the person in charge of your money, right? And so that stop is going to protect you. And then obviously there's, the optimal point where, where momentum starts to build against you. And anytime you start to get those layers, get through the layer where momentum builds against you, then you want to get out of the market. There's a question about doing a long-term trade setups and stops. Yeah, we could definitely look at an Apiary Live on long-term trades and stops. Definitely. And when using a 1-minute chart, would you find your stop on a longer time frame and then place your stop on a 1 minute? So again, the layers will be persistent across all time frames. So price action is price action. So we just identified a 1.150 stop on a daily chart. If we were to drop down into the 1-minute chart, you would see that same price point is going to influence trading around. That same price level will be evident on the smaller time frame charts. I don't have enough data here. Yeah, I do have enough data. So if we adjust this 1 point down to that 1.150 level, right there. So that's 1.1506. And again, that picks up, you can see that picks up trading on that 1-minute chart. So I guess the crux of that is that you need to know where those levels are on multiple time frame charts, not just your minute chart. But you definitely want to know where the levels are on the 5-minute chart, the 15, the hour, or whatever, because they're real and they'll influence your trading, either positively or negatively, right? All right. Well, hey, I think that we'll call it a wrap for today. Just to recap the takeaways from this little Apiary Live session. Stops, super important that we use them. We use stops either for ourselves or we use it to optimize opportunity or to minimize risk in the market. We use them for those three things. There's really no other reason to use a stop. You're either doing it for your own emotional fortitude, you're either doing it to maximize, make sure that you don't get out of the market and maximize opportunity in the market, and you're also making sure that you don't risk too much in the market. You can place stops really wherever for yourself, for your own emotional fortitude. Those can be placed anywhere using any technique. If you really want to dial in the precise points, then you need to identify the layers where support or resistance is going to form, and then make sure that you give yourself enough wiggle room below or above those support or resistance levels so that you're not losing too much and you're maximizing your opportunity. So there you go, traders. Great to be with you. And just another shout out to all those who came to the summit with us last week. It was phenomenal. We had such a great time meeting you all, trading with you. I mean, I can't imagine another place. You know, I've traded with a lot of people, been on a lot of different floors, but we had 160 people in one room using, every one of their computers are open, and we're sitting there trading. Everyone's trading together, and we're learning from the market. The market's teaching us, different principles about how to get in, how to get out, how to set up trades. And it was just phenomenal. So thank you to everyone who came to our trading summit last week. It was so fun. I had a great time trading with you. And we look forward to many, many future summits where we get to and hopefully you can join us next time. So at any rate, thanks to everyone for coming to the summit, and we'll look forward to doing another one of these Apiary Live sessions next Wednesday. We'll see you then. Thanks, everybody. Happy trading.